You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing.
Hello, I'm Deidre Willard, an editor at Millionacres, and thank you so much for tuning into the Millionacres Podcast. If you follow this podcast, you know Millionacres does crowdfunding reviews, and I always like to meet with the CEOs to learn more about their investing mindset. So you can read the review of CityVest on our website. What sets CityVest apart, and what I really want to talk to the CEO, Alan Donenfeld, today about is that it raises capital for access funds rather than investing directly into real estate investments. So it's really interesting, different mindset. So welcome, Alan.
Thank you, Deidre. Great to be here.
Tell us a little bit about what CityVest does and why you founded the company.
Sure. So CityVest is a online real estate investment platform, but specifically, rather than investing in individual real estate deals or properties, like most real estate crowdfunders focus on, we focus on real estate private equity funds that are more institutionally focused, bigger, larger funds, 30 million to 200 million in size, more experienced institutional investment managers.
Interesting. So this is different than a lot of the crowdfunders we talk to where you're investing in individual real estate deals. Why is this so intriguing for investors?
First and foremost, the investment fund managers are institutional fund managers. So they're audited, they've got administrators, they have significant amount of assets under management, typically over 100 million, many of them over 500 million. They have prior funds, so you can verify a track record. All too often you see on other real estate crowdfunding sites that there's a deal with a sponsor. The sponsor may be small. Sometimes those deals don't pass muster with any of the funds, and so they put them on a crowdfunding site. We want to focus on investment managers that when you give them money in a fund, they have opportunistic capital, where in this market, which is a little bit overheated, they can go out and, using capital in hand, take down a deal at hopefully attractive prices, better valuations, and on a time-sensitive basis.
Interesting. So these individual funds are holding a portfolio of real estate properties. Is it in a single location or across multiple locations?
Every fund is different. Both the investment management, the target locations that they're focused on, and their specialty of what they want to invest in. So there may be a specialty fund that only focuses on senior living in Texas. Another one might be industrial properties in Florida. Another one might be a GP co-invest focused on the West Coast. So it varies across a wide selection, and each fund manager has their own specialty investment niche, as well as kinds of deals that they're looking at and geographic target.
Interesting. So if you're an investor, how do you get started with CityVest?
CityVest.com is our website. There's a button at the top of the page that says investments. We have an array of different investments. You can click on the latest investment that we have without having to put in a password or your email address. You will then see everything about that particular investment. There are 5 or 6 tabs at the top of the page, including the overview, strategy, team, diligence, terms, documents. So it's an in-depth review, and track record. So it's an in-depth review of all of the information that you could want about that specific real estate private equity fund.
And you have to be accredited, right?
You have to be accredited. So after you've reviewed all of that material, if you then want to proceed, there are on our summary page, on the opening page, there usually are a couple of different videos where we or someone else interviews the investment fund manager. So that's always a quick and easy way to learn about the fund. And then we actually run daily group conference calls where any investor can log into our group conference call, ask questions. I'll go over the fund. So it's a very transparent and hands-on process.
Interesting. So how long do these investments stay open?
So typically a real estate private equity fund is a somewhat illiquid investment and long in nature. These are not, 2-year investments. These are not fix and flips. These are not credit deals that you might get your money back in 60 or 90 days. These are private equity funds, typically last as short as 5 years, as long as 8 or 9 years. But the investment fund managers don't really have a lot of incentive to let these funds run for the full 9 years. They're focused on getting a high IRR so that their next fund, that might be a $100 million fund, they want to generate the highest IRR that they can on the current fund so they can raise even more capital on the next fund. So they're IRR focused, and typically they start selling off assets in year 4 or 5 and don't even make it to the 6th, 7th, or 8th year of the fund.
One of the things I've noticed lately is we're seeing so much more deal activity. Is that something that you're seeing in the funds, that they are selling off properties a little early, or are they still keeping to their same timeline?
No, I think it's an opportunistic market, and I think many fund managers are seeing that the prices that they can get for their existing portfolio assets are much higher than they ever expected, and many people are taking those profits and then raising an additional fund that might be bigger. There certainly is a lot of interest both internationally and from domestic institutional sources to invest in funds, particularly if there's a given niche in investment strategy and in given markets. Obviously, the Southeast, Charlotte, and Atlanta are great markets. Many places in Florida, like Tampa, is a great market. Texas has been hot. And then many cities in the West Coast have a unique combination of both population growth and rising incomes, like Seattle, Portland, Denver, Phoenix are all great markets. And so if you find a fund manager that knows those markets well and is raising capital, those funds can raise capital fairly easily.
That makes sense. So there seems to be a lot of capital. A friend of mine called it kind of sloshing around lately. There's a lot of capital. There's a lot of funds that are popping up. I know it's confusing for the average investor. You look at over 700 funds a year. What are you seeing right now?
So there are a lot of funds. There are also fund managers that have around 50 million in assets under management, up to maybe 100, 150 million assets under management, and haven't operated 5 funds. If they're on fund 1, 2, or 3 and have had a great track record, then many of these funds are currently using a GP co-invest structure, which we like quite a lot because it allows our pool of capital, which typically when we invest in a fund, we're around $4 to $6 million investment. So a fairly big chunk of money for a given fund. And we're able to invest oftentimes in these funds as a GP co-investor, which means we can share in the promote that the manager of the fund has been able to attain from LP investors. It means that a 20% IRR, when you add in our share of the GP promote, we might earn a 25 or sometimes even a 30% IRR, much higher than the other LPs might get.
Interesting. Does that impact using SDIRA capital or taxes in any way?
Not at all. We accept self-directed IRA accounts, although, as you know, currently that's under discussion in the current tax rules of how private placements can invest in investments like ours for accredited investors. But no, SD IRAs are open to invest in our funds, and there is not a enhanced liability being a GP co-investor because we're shielded from that being a non-operating GP.
That makes sense. What are you seeing in terms of concern about potential changes? I know there's so much concern about the changes to 1031s, the changes for accreditation and private placements. How much is that impacting your investors?
We don't have any 1031 investors in our funds. I do see a lot of activity of investors who own properties wanting to sell now and get into either a new property, a larger property. And so I think that's spurred a lot of activity in the market for this year. We still don't know what's going to happen at 1031, but many people believe that that rollover of the taxes will change to some extent, and I think it is causing a lot of people to step into other assets and creating some extra product in the market today.
So I wanted to ask a little bit about the documentation. I know that a lot of that is really confusing for people. You mentioned office hours, that you have a conference call every day. How else do you help people kind of understand what they're investing in?
Having the group conference call is really the best way for any investor to learn about our funds and generally to learn about investing. So what we do, which I haven't really described, is we create a feeder fund. Our investors invest in our feeder fund. We'll aggregate that capital, and we invest in an underlying fund. The terms of both of those, our feeder fund and the underlying fund, are very confusing for individual investors. And these are all accredited investors, but I don't expect anyone investing in either fund to have a strong knowledge of the legal terms. Many of them do know what they are, things like a rebalancing contribution and catch-up provisions. Even a pref is sometimes not fully understood by a lot of investors. So we can explain that on our group conference calls, and some of the more esoteric terms like catch-up provisions and this rebalancing contribution, I can easily explain what they are. But more importantly, in our feeder fund, we have a side letter agreement with the underlying fund where we're able to negotiate better terms for those specific provisions. And so we're representing our investors in getting the best deal for our access fund or our feeder fund.
Okay, so as I understand it, then having that amount of capital invested kind of gives you a little more influence. Is that kind of how it shakes out?
Yeah, many funds that are raising a fund, say it's $50 million in size, if we come in with a commitment to invest $5 million in that fund, it's 10% of the fund. They may actually be seeking minimum investment sizes of $500,000, still out of reach for an individual. It's a big chunk of money. Some funds have $1 million minimum, but we're coming in with $5 million. So we're able to negotiate generally a 12% preferred return and 80 or 85% of the profits over that pref, while the underlying fund for direct investors, they may only be offering an 8 pref followed by 75% of profit. So because our feeder fund, we call it an access fund, comes in with a much larger check, we're able to negotiate better terms for our investors.
Can you explain what a pref is for people?
Pref is merely a hurdle. So 100% of net operating income generated by all of the real estate investments after the mortgage has been paid, that net operating income is distributed to investors based on their pro rata investment. And when investors have received, and I'll simplify it a little bit, when investors have received an 8% IRR, in the case of direct investors in these funds, after that hurdle has been achieved, and it's sometimes an IRR calculation, after that, then the profits, that NOI, is distributed 80% to investors and 20% to the investment management group. Now, that's only going to happen after 3, sometimes even 4 years, because there's no property that you can buy today that's going to have an 8% return out of the box. It would have to have a cap rate of probably 6 or 7%. It's just not available in the market today. So it might take a couple of years for rents to go up, net operating income to go up, to achieve an 8% pref. Now, in our case, we're generally negotiating a 12% pref, meaning 100% of those cash flows coming off the portfolio of real estate, 100% of that goes to us until our investors have achieved a 12% IRR. And after that, the investment management team starts to participate in those profits. Generally, in our case, it's an 80-20 split. Oftentimes, for direct investors, it might be 75-25.
Great. Thank you for breaking that down. So if you have, you're invested in these funds, how does it differ from individual commercial real estate deals? So like one of the things that's happened sometimes is you get in individual CRE deals, you get like a capital call or something like that if they need more money. Is there anything that happens like that in the fund world?
So as I described, we have a side letter agreement with these funds. And because we're coming in with something around $5 million, we negotiate our own terms of investment in these funds. So that specific term that you just highlighted, a capital call, we negotiate that away. I don't want to have to chase individual investors for a percentage of their investment in the fund. So I require the fund that we invest in to accept all of our subscription on the date that we're making our investment without any capital call. So our investors are not going to get another call from us saying it's time to put in some additional money because there's a 2 or 3 year investment period. No, we're investing all of it right up front without a capital call, and we're earning generally our 12% preferred return on that investment from day one.
Nice. So another concern I know that with individual CRE investments is taxes and the K-1s and having to file individual K-1s in different states depending on where you're investing. With the funds, is that an issue? How does that shake out?
K-1s are always an issue. So we have the underlying fund deliver a K-1 to our feeder fund because we are the investor. We have a very good accounting firm, and we will file a composite return in the states that allow a composite return. Therefore, let's just say we're an investor in North Carolina, South Carolina, and Georgia because it's a diversified fund and they have multiple assets. We will, on behalf of our investors, file composite returns, make whatever tax payments are required in those states for all of our investors so that our underlying investors in our fund do not have to file multiple K-1s in states. Having said that, there are some states that do not allow composite returns, like California, and so there may be a California state tax return if the underlying fund has investments in California.
California's always got to be difficult.
Always a problem.
So how do you conduct the due diligence when you're looking at a real estate fund manager?
Well, this is an area that I think differentiates CityVest from all other funds. So not only are we looking at 700 private equity funds, but right at the outset, these are not deals. These are not individual properties. This is not one of 10,000 syndications that are happening all over. These are fund managers that have a level of experience with auditors and administrators and have a track record for how they have performed in the past. So out of those 700 funds, if any fund manager has less than a 20% IRR over the past 10 years, I'm not interested in that fund because the last 10 years have been a spectacular time to be a real estate investor. We had this thing called cap rate compression where cap rates came down, which means that the rate of return that the investor expects is lower. Therefore, they're willing to pay a higher amount. So if you were selling an asset any time over the past 10 years, you got a much higher price for that asset than you paid, which means you have a great return. Everybody had a great return. If I look at a fund and they generated a 15% IRR, it sounds great on the surface, I don't really want to invest in that fund because every real estate investment fund manager should have been easily able to generate a 15% IRR. So I'm looking for outperformance. So one level of due diligence is finding managers, not just that they are an institutional fund manager and have a fund where you can verify the assets and look at their track record. I want there to be greater than 20% IRR. I want to see a auditor and an administrator. I want to see skin in the game where that manager is investing in the fund. And then another way that we do due diligence, once we've narrowed the number of investments down, is we contract with a third-party due diligence firm named Buttonwood, and they do a third-party due diligence review where they are also separately conducting due diligence on doing background reports, looking at SEC and FINRA records, whether there's any bankruptcies or liens or drunk driving arrests or a whole array of background checks on a manager. We post those reports on every fund that we're doing on our site just for transparency. It's there. The due diligence has been done.
I like it. You're a tough grader. All right, let's take a quick break here.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
Some of our listeners are undoubtedly among the fortunate group sitting on piles of valuable tech stock. If you're one of them, listen up. Urban Catalyst could help you with your tax bill when it comes time to sell. Urban Catalyst is the premier qualified opportunity zone fund based in Silicon Valley. And if you meet investors' qualifications and invest in a qualified opportunity zone fund, you could potentially get big tax breaks. Here's how it works. When you go to sell your stock, you will likely generate a large capital gains tax bill, which means Uncle Sam may want to take a large chunk of it. If you're not keen on sending all that money to the U.S. Treasury, opportunity zone funds like Urban Catalyst can help you shield those gains. And Urban Catalyst isn't just any opportunity zone fund. Forbes magazine and the Sorensen Impact Center ranked Urban Catalyst one of the top 20 OZ funds in the country. Don't wait too long. If you invest before the end of this year, you may not only defer capital gains taxes, but you also may be able to reduce your capital gains by 10%. And as an added incentive, if you hold your investment for 10 years, you will likely not have to pay any federal taxes at all on those gains. And it's not just stock sales. Capital gains from real estate sales, selling your business, or even a big crypto sale, these types of capital gains can all get potentially favorable tax treatment by investing in an opportunity zone fund. Urban Catalyst focuses on development in downtown San Jose, an area prime for growth and revitalization. You can learn more about the fund and the numerous development projects underway by visiting urbancatalyst.com/millionacres. But keep an eye on your calendar. You only have 180 days after your capital gains event to invest in an opportunity zone program. So visit urbancatalyst.com/millionacres today.
I'm back with Alan Donenfeld, and we're talking about all things real estate investing and crowdfunding, real estate investment funds. And in this segment, I want to talk about some of the things that are interesting in the future. So let's start with a little bit of a dip into the past and talk about how the pandemic impacted your investments and what kind of lessons you took out of it.
We had our best year ever. Funds were raising capital. And even funds were investing capital. There wasn't really a break where people took time out from investing, although it was extremely hard to travel and see properties. Deals were getting done. But on the operating side, we did see a slight dip in occupancy rates. Our focus specifically has been in multifamily, and so there was early in the pandemic some drop in occupancy. Clearly, rents were late by a month, 2 or 3, but at this point they've all caught up, and rent payers are right up there at 95% being current, and so it's as if the pandemic has not even happened, and the market is extremely hot. Rents are up across the board in virtually every city and every type of real estate, except obviously some cities like New York and San Francisco are still having some issues. Retail properties and some hospitality are still having some issues.
Yeah, absolutely. I think one of the things that's interesting about the pandemic, and I don't know if you saw this too, is that there was all of that kind of opportunistic capital waiting to be deployed and expecting commercial real estate rates to go down. That kind of never happened. Were some of the funds that you've seen that maybe got in a little, maybe didn't kind of pass your due diligence test? Did you see some of them kind of trying to scramble during that period of time?
No, most people that I saw were investing straight through the pandemic. There was a interesting line in Blackstone's annual report that they invest in real estate through all market cycles. It was kind of a throwaway line, but my guess is if you look at the details of even Blackstone's investments, that they were as active as ever right through the pandemic, didn't miss a beat, and I think anybody that did take a pause investing probably regrets it, because prices in 2021 and occupancy rates this year are both much higher than they were in 2020.
Yeah, absolutely. One of the things with the pandemic, we've seen real estate market interest shift a little bit. You know, you mentioned retail and hospitality. Money's kind of moving away from that. Industrial has been huge. Life science is huge. What real estate market niches are you looking at right now?
So we've consistently focused on multifamily. Our central belief is that the population in the U.S. is growing by about 2.5 million people a year. Commerce Department is projecting 440 million people by 2050. Now, we're not investing for the next 30 years. We're investing for the next 5 to 10 years. But nonetheless, 2.5 million new people a year. People have to live somewhere. We already know there is a housing shortage, and so it just goes to there will be continued rent increases. There is, this fix and flip market, which is renovating a significant number of houses. There are lots of houses being built for rent, which is an attractive segment, but we have stuck pretty much to multifamily. There are some segments of that, like workforce housing, student housing, are both quite attractive. In student housing, it's fairly easy to get the documents for any public university to see how the student population growth, and it's well known whether a given university is building any new dorms, which almost no university has built any new dorms for about 20 years. There are some, but not a lot. And so all those students are moving off campus. It used to be 40 years ago that everybody lived on campus. Then it was just, seniors moved off campus, then juniors. Now you have many freshmen, they go to college and they move off campus immediately. So the growth in university population is easy to see, and therefore you can extrapolate. Therefore, buying student housing near a given university would be a good investment. So there are pockets of multifamily that we like. There are some development opportunities in student housing, in senior housing. There is a growing older population. I think that specific market is very misunderstood, because the last 8 years or so, there was actually a small decline in the number of seniors at a time where lots of people were entering the senior housing market, and it was somewhat overbuilt. So you got down to occupancy rates in the senior housing industry that were down in the low 80s. And so now we see that senior population growing now almost exponentially year to year for about the next 15 years. And that should mop up all of that excess capacity. And around 2030 or so, there will need to be a lot more senior housing built, just because of the demographics and aging of the population.
Yeah, you just brought up two things that I think are really fascinating. Senior housing, I think one of the reasons that there was that oversupply, I think people misestimated when people are going to need that type of housing. People in their 70s, late 70s, not moving into senior housing, but we're all living longer. So I think you're absolutely right when you predict that when that baby boomer peak generation starts hitting their mid 80s is when you're going to see a bigger shift in that. And you mentioned student housing, fascinating sector. We follow American Campus Communities, which is pretty much the only REIT invested in that. And you made such a good point there too, because you've got this booming population, Generation Z, and they definitely they're all going to college, but the campuses just aren't seeing profitability in building it themselves anymore. So they definitely are making all sorts of partnerships.
Right. Universities are in the business of educating, not in housing students. So yes. any free land that a university might have, they're typically building educational buildings rather than student housing. All that student housing is being pushed into surrounding areas. So there's a lot of development by very large funds that's quite attractive in student housing. And just reiterate the senior housing point, because we did invest in a distressed senior housing fund. And so it's quite interesting that people, as you said, they're living longer. They stayed at home longer, or through the pandemic, they lived at home with their kids and even moved out of senior living. But because that senior housing population, is now on an upward path, it's easy to see that industry will flourish. There was overbuilding in senior housing for the last 5 or so years, but I think all of that excess capacity is going to be used up over the next 5 years.
Well, you also mentioned workforce housing, something we studied a lot at Millionacres, one of the things that we think about a lot too. I noticed that you guys launched the CalNeva Access Fund, zeroing in on workforce multifamily in California and in Nevada, which is growing by leaps and bounds. So what does that fund do?
So workforce housing is really housing for a lower middle income class of people, people that might make $40,000 to $75,000. A lot of teachers, firemen, other essential workers, and so it's obviously important to have that group of people be able to live in an area that's decent. This is not poor housing. This is just lower income. And so CalNeva has targeted their local market, which is Los Angeles, and specifically South Los Angeles, which is a very attractive market. In fact, Apple just announced last week that they're opening a new office building complex with 3,000 workers in south of Culver City, so somewhat south of Los Angeles. That's just the market that CalNeva is focused on. They also focus on Las Vegas, specifically North Las Vegas, where many of the people that work in casinos actually live. So it's a strong community. And the way that CalNeva operates is they are a fully integrated company with a construction, property management, and brokerage arm, allows them to buy properties at the right price. And typically, CalNeva is looking at low-income housing tax credit properties that might have graduated from the program, but the properties have not been fixed up, so they're not able to increase the rents. And they clearly have not fixed up the properties because there hasn't been the higher rents to provide that floor for more capital expenditure and renovations on the property. So CalNeva will fix up those properties, put in new kitchens, bathrooms, new landscaping, signage, whatever it might be, improve the properties and increase the rents to a market rate given the viability of the rents in a lower middle income tax bracket.
So I wanted to ask you a little bit about blockchain and real estate tokenization, something I've studied for a long time. It always seems like it's on the fringes of just being about to kind of take over in real estate, never quite gets there. How do you think blockchain could actually revolutionize the way we invest?
I spent a couple of years talking about tokenization of real estate. This is back in 2017 and 2018. I don't think we've seen an amount of institutional interest in tokenization of real estate. Some of the deals that have been done, a famous one was the Aspen St. Regis where it was tokenized. Investors came in. It was way overpriced. The money came from China. Um, I don't. I'm not casting dispersions on where Bitcoin comes from and who those investors are, but I believe in more traditional finance where investors have fiat currency. They're taxed on that money. We provide K1s in all of our deals, and our investors report their taxes and pay their taxes. And so, at least for the next couple of years, we're focused on fiat currency, making real investments with dollars, distributions in dollars. We do have some international investors that invest in our funds, but it's only if they have U.S. bank accounts, and we'll determine in 3 years, 5 years whether Bitcoin or Ethereum investments in real estate make sense. There's plenty of capital out there in fiat currency. I don't think right now we need to go searching for money in Bitcoin.
Interesting. So, when your investors are looking at your funds, what kind of considerations do they have? Are they curious about ESG or impact investing or anything like that?
Not particularly. They're looking for a passive income investment that is safe, as generally real estate is considered a safe hard asset, real asset. They like the fact that there are tax benefits through depreciation in our equity funds, and so we have just a growing interest in our funds that are directed towards passive real estate investors who invest. They want something that has an audit administrator, and our capital raising for our funds has grown month to month.
So, speaking about real estate as a safe investment, one of the things that is happening now is we're seeing inflation being talked about a lot. We're seeing potential for interest rates rising. What is your view on the impact of inflation on real estate investment returns?
So the traditional line is that real estate is a hedge against inflation. So that's what everybody will always say. We are cognizant that interest rates will rise. It's a very complex calculation. If interest rates rise, as they will, then the cost of financing an acquisition will rise. Theoretically, that could depress the amount that people are willing to pay for real estate, could depress the price. However, generally, as we have inflation, rents, incomes will rise, and rents will increase. It's hard to see how much more rents can increase because they've been on a tear for a solid since the Great Recession, since 2008 2009. Rents have steadily increased, so it's hard to see that they can go up much. But generally, with inflation, incomes go up. We know that across the board, everything is costing more. I believe that incomes will go up, rents will go up, and the net operating income, the profitability of real estate will go up, and therefore people will spend more. Regarding a very important cap rate, many people also think that if interest rates go up, cap rates will go up. I personally don't think that cap rates are going to go up very much because I think that over the last couple of years, real estate has been discovered by by additional sectors of investors, notably accredited investors through sites like ours. And so if people can now invest in real estate, which is generally a safer asset, people understand real estate, there's just more demand to invest in real estate. I think that will serve to keep cap rates down at lower levels just because there's greater demand. And I think real estate valuations will continue on up. Again, population growth, people have to live somewhere, valuations will continue to increase. So I don't see cap rates going up with the same pace as interest rates go up. We could see a spike in interest rates if we have a huge infrastructure stimulus in the trillions as discussed. But still, that I think will cause incomes to go up. There's going to be a lot of money spent on a whole variety of infrastructure projects and money for salaries. And so I think valuations will continue up and cap rates will stay low.
That makes sense. All right, last question for you, Alan. What do you see as the goal for the future of CityVest?
So we always want to improve the quality of our deals, although staying true to our mission, which is providing access to institutional real estate private equity funds for individual accredited investors. We will continue to provide that product to our core audience. And I think that one thing that might change is our minimum investment in our funds, which right now is $25,000. It's likely to increase to $50,000 or $75,000 per investor. The amount that we will then have to invest in individual funds will likely go up to $7.5 or $10 million in each fund. We will continue to do deals on a deal-by-deal basis where we find the best product in the market, the best nimble managers providing outsized returns. And so I think we will continue to do what we're doing. Maybe one of the changes for CityVest will be that we will have our own capital to provide liquidity to our investors. So if we have a 5 to 8 year fund, an investor says in year 4 or 5 or 6 that they need capital for any reason, health or any reason, our fund that we hope to put in place in the next year will provide that liquidity. We'll buy in the investor so that the stigma of real estate being an illiquid asset hopefully won't be much of an issue.
Interesting. Okay, that made me want to ask one more question, which is, in terms of CityVest and investing in different funds, do you recommend that your individual investors invest across a variety of different funds? How do you think about diversification?
Diversification is one of the top rules of investing. You don't want to be in any one, overweighted in any one asset. And so by the nature of a fund, typically these funds are in 8 to 15 different individual properties. So each fund itself is diversified. But I recommend to our investors who are saying, should I put in 25 or 50,000? I could do up to 100. I say, put in 25,000. Dip your toe in the water, see what CityVest is like. Do 4 different investments of 25,000, having a total of 100,000, and being diversified not just in each fund across a number of assets, but by the exact strategy and also geographically. Right now we're in Los Angeles. Our last fund before this was in Atlanta and Houston. We're looking at another fund that's in Texas and Phoenix and Denver. And so I recommend to be diversified by city and investment manager, and investing smaller amounts in multiple funds.
Very, very smart. Well, thank you so much for your time today. A reminder to listeners, you can learn more at cityvest.com. Stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discussed at Millionacres, or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.